So if you look at Bitcoin's price right now, I mean, it basically looks like a heart monitor flatlining, just completely stagnant.
Yeah, it really does.
Right. But that stagnation is a total illusion. Today, we're doing a deep dive to look under the hood because, well, our mission is to analyze the hidden structural shifts happening beneath this seemingly calm price action.
Exactly, because there are massive corporate security and regulatory maneuvers actively reshaping the whole ecosystem right now.
Which is wild. So let's start with that flat line. You were saying it's entirely synthetic.
Oh, absolutely. Algorithmic market makers are artificially compressing the volatility. So under the surface, you have these automated bots dynamically placing massive buy and sell walls.
Trapping it.
Right. It's effectively trapping Bitcoin in this super tight range between $64,800 and $65,500.
Which really raises the question, is this tight consolidation like a coiled spring waiting to snap? Or is it just dead money? Because if we look at the corporate filings, treasuries are treating this market structure completely differently.
Yeah, I mean, the contrast is stark. You look at Strategy Inc., and they are actually selling Bitcoin right now.
Wait, really? Selling it?
Yeah, to fund $108.6 million in preferred stock repurchases. So they're treating it just like a traditional corporate asset, to fortify their balance sheet.
Okay, wow.
But meanwhile, Strive Asset Management aggressively acquired 6,236 Bitcoin in Q2. And that's despite posting a $257.6 million net loss.
So is this massive divide between legacy corporate finance playing defense and, native crypto treasury management playing aggressive long-term accumulation?
Exactly.
But, while corporations are fighting over supply, the actual protocol layer they're buying into is currently under severe attack.
It really is. The recent BTCPay Server exploit is a prime example of this.
Right, the one targeting older versions?
Yeah, specifically software versions prior to 2.4.2. Attackers exfiltrated what are called macaroon files.
Which are basically highly privileged digital ID badges for Lightning Network nodes.
Spot on. So once the attackers grabbed those from poorly secured servers, they didn't even need to crack the encryption. The system just saw the badges, let them walk right in, and allowed them to drain the funds.
Man, that brings up a massive operational reality issue. I mean, if running your own sovereign node means you have to maintain a highly vulnerable hot wallet connected to the internet 24/7.
It's a huge risk.
Right. Doesn't this fragility force users to just abandon self-hosted nodes? Like, people will flock to custodial Lightning as a service providers, which completely defeats Bitcoin's original peer-to-peer ethos.
Well, yeah, ideological sovereignty is already losing to basic loss prevention. I mean, the threat landscape is evolving so rapidly that self-custody is basically becoming a massive liability.
And it's not just basic hacks anymore either.
No, not at all. North Korea's Kimsuky group is now running offline, open-source AI models, like Llama, to evade network detection entirely.
So they aren't just brute forcing passwords. They're basically running this offline, automated social engineering factory, right? Just to trick the humans holding the keys in institutional multi-sig setups.
Exactly. The localized AI eliminates language barriers and creates these flawless deepfakes and phishing lures.
That is terrifying.
It is. But, the shift away from self-custody isn't solely being driven by hackers. Governments are actually leaning into this friction to reassert control over the network.
Ah, right. Building walled gardens around domestic crypto liquidity.
Precisely.
Which brings us to Brazil's new mandate for 2027. This is the perfect example. They are requiring a mandatory 24-hour hold on outbound transfers over $10,000.
Which is a huge deal.
It's massive.
Yeah.
If you rely on stablecoins for instant cross-border settlement, this completely breaks that utility.
Oh.
And stablecoins currently make up nearly 72% of Brazil's total crypto activity.
Yeah, it introduces massive deliberate friction. And South Korea is executing a really similar domestication playbook.
Right, with the megabanks.
Yeah, they're allowing their megabanks to acquire domestic exchanges while aggressively blocking overseas competitors from the Play Store.
Wow.
And even retail platforms are building their own walled gardens. I mean, Robinhood's new proprietary Layer 2 chain captured $312 million in total value locked.
Just by internalizing their own retail order flow.
Exactly.
Though they marketed that network for real-world assets, and yet 79% of the volume is driven by meme coins like CashCat.
Right, so they are privatizing the profit of user activity while keeping users locked firmly inside their specific controlled ecosystem.
So the big takeaway for you listening here is that staring at the spot price is just a complete distraction. The real story is this rapid institutionalization and domestication of the network happening right under our noses.
Yeah, the surface looks flat, but the fundamental architecture of who holds the assets and how they are permitted to move them is shifting dramatically.
Which leaves us with a critical question to ponder. If governments and corporations successfully fence in liquidity, and users are pushed toward custodial solutions just to avoid AI hacks and protocol exploits,
Right.
does owning the base layer asset even matter anymore for the average user?
Yeah.
Or are we basically just trading a decentralized network for a newly fenced-in banking system?